I've advised hundreds of entrepreneurs and business owners on buying and selling companies. And one of the biggest things that people don't understand is how to value their business or figure out what your business is worth. My name's Matt Bodnar. I'm a private equity investor, Goldman Sachs alum, former Forbes 30 Under 30 winner. I've done more than $100 million in deals, and I'm a partner and owner in businesses doing more than $100 million in annual revenues. I want to talk to you about how to value a business. Valuation can be very complicated, confusing, have lots of math, and get very tricky. I like to boil it down to something that's really simple and easy to understand. One of the most important things you need to think about or know when you think about valuation is the fact that valuation is an art and not a science. What does that mean? That means your valuation is debatable, it's changeable, it can be impacted by factors you control and factors you don't control. There's all kinds of things that can go into a valuation. It's not one exact, precise, scientifically knowable number. You may end up at a specific number, but it's much more a process of being in the right ballpark and whittling down, understanding dynamics that are going on both within your business and in the market as a whole, and how those things interplay so that you can come up with a reasonable framework to understand the company's value. I'm gonna give you a very simple way in this video to instantly think about and understand the value of your business. Is it gonna give you every possible valuation metric? Are we gonna go deep into discounted cash flow models and crunch through some spreadsheets? No, but I'm gonna give you a way in about 30 seconds that you can figure out roughly what your business is worth and understand some of the fundamental pillars of valuing a business. What are the things that go into valuation? The easiest way to think about it is to take the earnings of a business and multiply that by a multiple of those earnings. That in itself is one of the simplest frameworks for valuing a company. You take the earnings, you apply a multiple on those earnings, and that's how you get a valuation. That's it. But both of those things, both the earnings side of the coin and the multiple side of the coin, can be very complicated. There's lots of negotiation and debate that can go into both of those. Let's start with earnings. What are the earnings of your company? You'll often hear two big terms get thrown around in the M&A world or when people are talking about valuing companies. One is SDE and the other is EBITDA. SDE stands for Seller's Discretionary Earnings. EBITDA stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. Both are fancy ways of basically saying how much does the business make. They're both proxies of free cash flow or trying to answer the question of, if I buy this business, how much cash is the business going to generate for me? Let's start with EBITDA and then I'll explain SDE because SDE is mathematically a larger number than EBITDA because it adds in things that EBITDA often doesn't consider. Earnings before interest, taxes, depreciation, and amortization. Effectively, what you're trying to solve for here is the net income of the business plus any non-cash expenses, which would be things like depreciation and amortization, plus any interest and tax payments. Why do you add those back? Because if the current owner of the business has a loan that's charging them $100,000 a year of interest, and I buy the business all cash, I won't have that loan anymore. And so that 100K is additional profit that I will have and profit that you can add back into the cash flows of the company, regardless of what's called its capital structure or regardless of how much debt the business has. So it's a way of looking at the operating income or the earnings or the free cash flow of the business without thinking about or contemplating what loans the company has or doesn't have. The easiest way to calculate EBITDA is to take your P&L, go through and add back in those line items, interest, depreciation, taxes, etc. That will get you a rough EBITDA number. We'll talk about adjustments in a second and add backs because those can also be hugely impactful. But to start, that's a pretty easy way to get at least a base case understanding of what your EBITDA is. It's your net income plus a few of those items gets you to your EBITDA number. What is the difference between EBITDA and SDE? SDE is taking your EBITDA and then adding back in the seller's discretionary earnings or the seller's discretionary expenses that they paid themselves out of the business. So you're gonna take the seller's compensation, you're gonna take your cell phone bill, if you have any personal expenses that run through the business, if you have season tickets to the football game, if you have your car or any family members on the payroll, all of the discretionary things that you pull out of the business will go back into your SDE calculation. The reason you do that is the same reason that you apply the EBITDA math. It's to see, again, if you sell this company and somebody else owns it, how much money is available for them to either distribute or pay off their lenders or have as cash flow. And if you, the owner of the company, are paying yourself an extra $50,000 a year and you have season tickets and you do $10,000 a year of charitable contributions and all of these things, those are things that the new owner can decide or that are within their discretion, right? Seller discretionary earnings, within their discretion to spend. So oftentimes you'll take EBITDA, you add back all the seller's personal expenses and their salary, and that's how you get to SDE, which structurally will always be a bigger number than EBITDA. The question is, when do you use each of these things and how do you decide? SDE is often used for smaller companies where someone is stepping into the owner's role or they're buying the business. A lot of times these businesses are more like large jobs than businesses where the purchaser of the company is stepping into that role and they're taking all of that compensation as the business owner. Maybe they're stepping into a consulting business or they're stepping into a plumbing company where they're going to be responsible for working and operating the company. And so some of that cash flow is going to go towards them. EBITDA is typically used for larger companies, larger businesses where there's an existing management team that's different from the owner of the business. A rough rule of thumb, it's not perfect, but a rough rule of thumb is once you cross over around maybe $500,000 to $700,000 of EBITDA, you're generally going to be talking more about EBITDA and less about SDE. Where if a business has $100,000, $200,000, $300,000 of profit or SDE or earnings of some kind, you're usually going to be talking about SDE. Those are the two different contexts. It's not a perfect rule of thumb, but if your business is an owner-operator type business where you or the founder is intimately involved in operating and running the company, you probably should look at SDE. And if you're running the business with a management team, you should think about using EBITDA instead. Now let's talk about adjustments for a second, because you'll oftentimes hear adjusted EBITDA instead of just EBITDA. What does this mean? There's all kinds of things that can go into this. They're often called add backs, and they're things that you would add back in using that same guiding principle. If I'm gonna sell this company, are these expenses that the new owners of the business would have to incur? If you had a one-time legal bill of $50,000, that might not be something the new owners of the company would have to spend. And so that would be a legitimate thing to add back in to the business's EBITDA to get to a higher number. I once purchased a company where the owners had a condominium in Florida that not only all of the repairs, maintenance expenses, condo fees, etc., were paid out of the company, but everything associated with that condo was paid from the business and it was owned by the business. In that case, it was an obvious thing to add back, right? We weren't buying their condo in Florida, and so we added all of the related expenses back into their EBITDA number. What does that mean? If you're selling a company, you want to be really thoughtful about including everything you can into your adjusted EBITDA number. Let's look at some example math really quickly to show you what I'm talking about. If a business has $250,000 of net income on its P&L, and that same business had $50,000 of depreciation and $50,000 of interest expense, that business would go from $250,000 to $350,000 when it moves from a net income calculation to an EBITDA calculation. If that same business had an owner's country club dues that they pay, and those are $25,000 a year, and the owner contributed substantially to a local charity that they really cared about, and that was another $25,000 a year, and the owner had a family member on the payroll, that was another $50,000 a year that weren't really working in the business. That $25K from the country club, plus $25K from the charity, plus $50K from the family member, adding those back in takes that business from a net income of $250 to an EBITDA of $350 to an adjusted EBITDA of $450. And that's the same business without changing anything else. If you take a 5x multiple on EBITDA, which we'll talk about multiples in a second, if you take a 5x multiple on that business's EBITDA and apply it, the difference is pretty substantial. 5 times 250 is a $1.25 million valuation. 5 times 450 is a $2.25 million valuation. Just by going through the exercise of figuring out the EBITDA, figuring out any one-time add backs or adjustments, that business has added $1 million to its valuation without changing anything else and without changing the multiple. That's why add backs are so important. It can literally be the difference easily in terms of hundreds of thousands of dollars, if not millions of dollars in the business's value. And it's something that's worth taking the time to understand. Hopefully this gives you a snapshot way of thinking about the earnings side of the puzzle. There's a lot more that goes into it, which I talk about in other videos, but this should at least give you a snapshot of how to think about the earnings side of the equation. Remember, earnings times multiple equals valuation. The earnings side is much more complex. There's a lot of other things that can go into it, which I talk about in other videos. But for now, this should give you a good sense of how to roughly approximate the EBITDA or the adjusted EBITDA of your business. I love this meme because it really showcases exactly what I'm talking about, the difference between net income, EBITDA, and adjusted EBITDA. This to me is a perfect example of the massive difference that you'll see. And if you start looking at companies to buy especially, you'll see a huge delta in companies and how they list their net income versus their EBITDA versus their adjusted EBITDA. But this is a perfect way of encapsulating it and showing you visually how it really works. How should you think about multiples? One of the most important things to understand on the multiple side of the equation, not all businesses are the same value. In fact, some businesses are massively more valuable than others. I'll give you a pretty stark contrast to give you a sense. Let's compare a construction company versus a software business. Which of those is more valuable and how does that impact their pricing multiples? First, let's talk about revenue. A construction business's revenue is typically highly volatile, very sensitive to changes in the economic environment, i.e. people don't start massive construction projects in the middle of a recession typically, and it's very project dependent, which means you start a big construction project, you work on it, and then once that project's over, somebody's not hiring you to build their house again after they've already built it, right? Or to build a new office building after it's completed. So it's very project-based, volatile, and very lumpy. Versus a software business, which are almost entirely driven by recurring revenue. It's contracted, it's long-term. Software businesses typically have a 5 to 6% annual churn rate. So software businesses are very sticky, very predictable. They sell a customer one time, that customer pays them for years. Which of those two revenue streams would you rather have? Let's compare them on another axis. Asset base, equipment, and capital expenses. Construction businesses typically require a lot of heavy assets. You have to go buy excavators and earth movers and dump trucks and all kinds of heavy equipment and things that are very expensive. Software businesses require almost no assets. You don't have to go out and spend hundreds of thousands or millions of dollars on heavy equipment. They're very asset light. So which of those things would you rather have? A business that constantly requires huge reinvestments in equipment to grow, or a business that can grow with almost no additional capital investments? Let's look at gross margins. A construction business has labor and materials, which are both substantial expenses. As that business scales, even if it's doing 8 or 9 figures in revenue, huge chunks of those margins, 20 to 30% for each of those categories in a lot of cases, are getting eaten up by labor and materials. Versus a software business, which has largely fixed infrastructure costs, a team of software engineers, the payroll of the company's operations, but there's very little cost to replicate or scale. To copy paste that software code for another customer costs virtually nothing other than hosting expenses, and software businesses routinely operate at 90% plus gross margins. Which of those margin structures is more attractive? One that has extremely high fixed costs, or one that has virtually no incremental cost to scaling? As a result of those things, let's look at the fourth comparison factor, scaling. Which of those businesses is easier to scale? The construction business or the software company? You read in the news about a lot more billion-dollar, massively successful software businesses because they scale much more effectively. Now, let's bring this back to multiples. If you have two businesses, one's a construction company and one's a software business, and they're both doing $5 million of revenue and they're both doing $1 million of profit, should you buy each of those businesses for the same price, given everything we just looked at? Certainly not. In fact, the market helps us price those things out. And what you'll see is that software businesses trade at massively higher multiples than construction businesses do because of all of those factors and many others, but those are some of the most important factors driving that valuation gap. In fact, those two businesses, that same construction business doing $5 million of revenue, $1 million of profit, might trade at 3 times EBITDA or maybe 4 times EBITDA, which would give it a $3 to $4 million valuation. That software business, depending on a lot of things, its growth rate, other things, could trade anywhere from 3x to 10x revenue. So that could be a $15 million up to a $50 million valuation, which is a massive gulf between two companies that, if you strip the name of the industry away, would have almost the exact same financial characteristics. That is the power of multiples, and all industries are not created equal. This chart right here from the Pepperdine Capital Markets Project, which is a great third-party independent resource on valuation, which looks at hundreds of private business transactions and puts this report together on a regular basis. It's one of my favorite resources for valuation, by the way, and you should definitely check it out. But the Pepperdine Capital Markets Project put this report together that demonstrates the impact on industry across a number of different sectors, and it also looks at it at two different sizes. So businesses that are doing less than $1 million of EBITDA and businesses that are doing between $1 and $5 million of EBITDA, which captures the vast majority of business transactions that you would typically look at. What we can see from looking at these multiples is the same thing. Materials and construction businesses typically trade for lower multiples than other businesses. But there's something else on here that's also really important from a multiple standpoint. Size. Size is one of the other major factors that contributes to a business's valuation. The bigger the company, the bigger the multiple it'll trade for, all things being equal. Why is that the case? Because there's a lot more money chasing fewer deals at the higher end of the spectrum. Why is that the case? For starters, bigger businesses are typically less risky than smaller businesses because they have more infrastructure. But the easiest way to think about it is a private equity fund that's doing a deal. It's the same amount of legwork for them to buy a $10 million business as a $100 million business, but they're gonna make a lot more money on the $100 million deal. There's also a huge ecosystem of lenders. The bigger the company gets, the more capital options there are for those companies. So bigger businesses typically trade for much larger multiples. You could have a business in the same industry, a generic service company, that if it's doing $500,000 of EBITDA might trade for a 3 to 4x multiple. And if it's doing $10 million of EBITDA might trade for double-digit multiples. Same exact business. That is the power of size and how it impacts multiples. There are a lot of other factors that can impact multiples as well. In fact, I think about multiples as basically being on a spectrum from low to high. If you took an average business, we'll say a services company that's doing $500,000 to $1 million of EBITDA, that business may trade somewhere in the ballpark of a 3x on the low end and a 5x on the high end with a midpoint of around 4. That would be their multiple. There's tons of factors that can move that business either to the high side or even beyond the high side, or to the low side or even beyond the low side. Without going into detail, because this is another hour-long plus conversation, things like management concentration and the quality of the management team, growth rate, financial performance historically, volatility of its earning stream, the asset base, how long the company's been in business, economic factors that are currently impacting that industry, how sophisticated are the systems and processes that the business operates on, does the business own any intellectual property, what are the business's competitive advantages. There are lots of different factors that can impact a company's multiple and valuation, both internal to the company and controllable, and external to the market. Those are a few to think about. Let's wrap this up. How do you think about valuing your business? We talked about earnings. You can take out your latest P&L, look at the last 12 months or the last year, go through and do the basic math of adding back in the EBITDA add backs, so your interest, depreciation, taxes, and amortization. Do a little bit of homework of thinking, are there any obvious one-time expenses that I should be adding back here that maybe aren't on my P&L on a normal basis or a new owner of the business wouldn't incur from an expense standpoint? Add those back in and get a rough number, a rough proxy for what your earnings might be. Then take that Pepperdine Capital Markets data that I showed you a minute ago and pick the industry category that roughly fits your industry. Now, let's go back to that multiple spectrum concept and figure out, based on a lot of these factors that we talked about, does the business operate without you as its owner? Does the business have a fast growth rate? Does the business have a history of profitable operations? Does the business have systems and processes? All of these different factors can be hugely impactful, but do your own rough assessment of whether or not you think the business is on the low, medium, or high side of that spectrum. You can use the Pepperdine numbers as a midpoint. Just using that, you should be able to get a reasonable estimate. Now, there's a lot of other things that could impact it, but a reasonable estimate for where your business should be valued today. You take that earnings number that you calculated, you take the multiple based on where you think it is on the multiple spectrum, and you multiply those two things together. Now you've got at least a rough sense, a ballpark of what your company is worth. I hope this was a helpful illustration of how to think about the value of a business. It's a very complicated topic. There's lots of other elements and lots of other things that we can unpack about all of these pieces, but I'd be curious to hear your perspective. Did this make sense? What are your thoughts on valuing a business? And tell me in the comments what other ideas or thoughts you might have around how companies should be valued. Thanks so much for watching the video. If you liked it, check out one of my other videos.